week, DukascopyTV spoke to Standard Chartered's Mike Moran about the euro, the dollar and the yen. Now, to get a slightly different perspective on some of the traders' favourite currency pairs, I'm joined by New York-based Westpac currency strategist Richard Franulovich. Richard, there's a lot of attention on Europe at the moment and indeed the US, and it appears that even good positive news that's coming out of these economies is failing to impress and settle the markets the way it was planned to. What's your outlook for the euro versus the dollar?
Well, the euro has now had a pretty big tumble from its highs just above 145 a few weeks back. So, and there's been an aggressive liquidation of positions. It is down into the low sub 135, 133.50 zone. It was oversold, and so we do see scope for a technical correction in the near term, just to unwind this oversold condition. So I see a rally, the basis for a rally perhaps as high as 138, 139. In the next week or two, purely a positional adjustment. Beyond that, however, we see euro down to the low 130s into year's end and into 2012, simply because the fundamental problems around the EU crisis, Greece, Ireland, Italy, Portugal, the size of the EFSF, the bailout fund, is too small. It's not enough to ring-fence some of these debt-distressed nations. And basically the politics surrounding any ability to expand its size, its remit, its flexibility remains mired in politics and opposition within some countries such as Germany. And the bottom line is we see scope for a positional bounce, perhaps as high as 137, 138 near term. But the ability of the authorities to decisively expand and increase the flexibility of the EFSF in Europe is hobbled. And for that reason, we expect the crisis to continue to roll on into 2012, and that will ultimately weigh on the euro further.
What about for a commodity-linked currency like the Australian dollar? How is all of this going to affect, say, the Aussie dollar, US dollar in the near term and when we look forward in 12 months' time?
Right, well, the Aussie dollar is, I mean, if you look across all asset classes, even beyond currencies, you can see how everything is exceptional. The correlations have now basically risen up towards 1, which is to say everything's basically trading off the one singular story, and that is this intense focus on the travails in Europe. Now, to the extent that there is some near-term, that the Aussie dollar, like the euro, has been oversold, there are some hopes that the authorities are getting ahead of the crisis in the short run. We see scope for a euro rally. That should also assist Aussie. So as we speak now, currently it's already grinding higher. We think it's probably got room to rally up towards parity. Maybe 101 on a 1 to 2 week horizon, consistent with the euro bouncing up towards 138. But further out, the global growth picture, or the prognosis there, is not particularly encouraging. Chinese growth looks like it's slowing, perhaps dramatically, particularly in the export sector. US growth obviously remains somewhat subpar and hesitant, and the European economy is obviously slowing dramatically as well. You put that all together and you basically have the recipe for a weaker profile for commodity prices, and if anything, there are heightened risks of the RBA easing rates. So you put that all into the mix, and whereas we see Aussie near term perhaps bouncing up towards 101, we think that's probably a good opportunity to look to short the currency, looking for it to pull back into the mid-90s by year's end and into 2012.
Looking forward though, Richard, what about the dollar-yen? Global growth is looking sluggish at the moment, so in light of the current market conditions, where do you see the dollar-yen heading over the next year?
Okay, well, dollar-yen's been pretty much comatose for the better part of a few weeks now. It's been travelling in a 76, 78 range. I, like many colleagues in the FX market, basically believe the yen is a fundamentally, inherently, deeply flawed currency. Japan, the economy has zero growth prospects, interest rates are negligible, and the long-run prospects for the economy are fairly negative. Not to mention, of course, you have the debt load that the government is carrying, which is at some point the currency will have to pay attention to. So, despite all those negatives, which would argue for dollar-yen being much higher than current levels, the fact remains that the currency has been something of a safe haven play, particularly amongst Japanese mums and dads. Every time there's any sorts of volatility, risk aversion spiking, you tend to see the yen strengthen. So despite all the negatives weighing on the currency, to the extent we think the European crisis will remain unresolved, global growth will be slowing, we think dollar yen ultimately is probably going to head lower, down towards the low 70s. Despite that, we do think it's a fundamentally unattractive currency. but in times of exceptionally high risk aversion, it will continue to strengthen.
Richard, that was great, thank you. There's a lot of great information there to keep our traders updated. Now that's all for today's edition, but stay tuned for more Targets in Focus throughout the week.